Uh, Thank you to everybody for joining our webinar today, Mastering Crypto Accounting. Today we have two wonderful speakers. Would love to introduce Jeff Rundlet, Head of Accounting Strategy here at Cryptio, Anuj Puri, who is a PwC partner in the accounting crypto side, and then myself, I'm your moderator for today. I'm Tremaine Hudson, Senior Accounting Strategist here at Cryptio.
Hey,
Just to
bro.
give you a, oh, sorry, yeah, should probably let you guys say hi, right?
No, just saying that.
So agenda-wise today, we're going to be looking at two different sides. Anuj is going to kick things off with just giving us a good lay of the landscape in crypto accounting from what he's seen over at PwC, and then Jeff will jump into some of what the more product audit readiness side of things and any recommendations we have just in terms of getting yourself ready for upcoming audits in the crypto world. So without much further ado, Anuj, if you want to introduce yourself.
Cheers. Thanks, Tremaine. Morning or evening, everyone, depending on where you are. Really good to be here. Thanks so much to the Cryptio team for inviting me to the session. Quick introduction of myself. I'm Anuj. I'm an accounting advisory partner based here in Hong Kong. I'm basically an accounting advisory partner by trade, but I like to think of myself as a true crypto Web3 believer. I've been in this space now for a good 5-6 years, part of our wider digital assets team. We're now a 50 plus member team serving clients across different disciplines on digital assets. So I'm a founding member of that team, also founding member of our global crypto accounting working group. And hopefully that speaks to the belief that we as a firm have in the crypto and Web3 space. Really just, most of us in the team, huge believers and supporters of this community. And hence the reason why I'm here, all about so the accounting challenges and what I've seen over the years working with a number of companies. Before I get into the session, just maybe two quick points in terms of the sort of context of the backdrop of this. I assume most of the folks on this session are from startups. So, the lens through which I speak will be more directed at, challenges that I have seen startups grapple with. But by all means, if, some of you have questions from a different perspective, please do feel free to raise them. And the second thing is, I assume most, if not all, are from outside of the US. So everything that I speak to is from a non-US context. And I say that because I think the world can be quite different depending on US, non-US in terms of just accounting rules and how things are applied. So those are sort of the two kind of quick points I wanted to make before we jump into the session. So maybe we can move over into the session.
Anuj, before we jump in a little more, I think your audio is a little bit choppy right now. I'm not sure if it's just like positioning or maybe.
Oh, sorry. Is it better now?
Yeah, I think so. I think it's a little better. I'll let you know, but I think we can kick things off. Sorry about that.
All right. Well, I'll try and speak closer to the mic.
Apologies. Yeah, much better.
Big head. Right. So I guess just kicking things off here. When we were thinking about doing this session, I obviously asked myself, if I'm in the audience as a founder or as a employee at a startup, why do I care about accounting? And so what is it really in this session that I need to think about, right? And I guess to me, it was more about the lens through which people like your investors and VCs who you quote for fundraising and how they view things is I think quite important. If it was a traditional startup, we typically don't see them being so acutely focused on accounting and bookkeeping. Yes, of course, it's good to have your statutory accounts done, and of course, it's good to have so forth. So it's a good kind of housekeeping. But I think what's different in the crypto and Web3 space is how VCs and investors generally think. And they are quite focused nowadays on actually getting involved with the operational side of things in order to generate alpha. right? This is also to do with, valuation challenges and just performance challenges that they have seen with their portfolio companies. So when we speak with VCs and investors, we oftentimes see them having a pretty acute focus on driving some of that operational expertise. And I'd say accounting and bookkeeping is just very much part of that, because if you don't have good bookkeeping, if you don't have good operational expertise, that just your valuation as a startup. So we move on the next slide, Tremaine. What we wanted to just highlight here was there's a number of operational issues that can lead to value erosion. So you'll see there a number of things: risk management and controls, regulatory compliance. But what I think we focused on today is accounting and audit. And again, the point here being that whilst in a traditional startup, you can get away with perhaps not being as acutely focused. In the crypto and Web3 space, just given everything that has happened, the challenges of just the space in terms of data management, and I will speak to some of that. This is just something that VCs and investors have also been acutely focused on. And so as a startup, it is well worth your time to focus on these issues, because as part of the fundraise, when you go through some of those discussions and conversations, if you are not able to provide the clarity to your investors, it definitely does create a bad impression, and can also, as I said, lead to undervaluing your company. So that's just to set the scene as to why, if you're a startup, you should still care about crypto accounting and audit. So moving on from there, hopefully that paints the picture. Wanted to talk a little bit about what we've seen in this space. And again, before I talk about the points that you see on the slide, I did want to also highlight that we as a firm have worked a lot with startups, and there is a perception in the market that PwC will only ever work with the big names in town. And actually, that's a perception that I want to dispel. We do actually work with startups, oftentimes through a number of VCs that to look at the company and evaluate it from a financial due diligence perspective. But we got now a fair bit of experience working with startups such as yourselves. So the collective experience of having worked on those projects is what I've used to kind of highlight some of our experience here. So I go back to that. Yeah. So I guess first point is just rudimentary accounting tools. They are virtually non-existent. A lot of the traditional accounting softwares, as we all know, do not cater to crypto. And so what we see as a result is just basically spreadsheets. And spreadsheets are everywhere. Companies are using spreadsheets to do their management accounts, all of their bookkeeping, all their management reporting. Just everything is based on spreadsheets. And what is aggravating that problem is the ability to get reliable data feeds. So obviously, you're interacting with different platforms, custodians, exchanges, other blockchains, and being able to just get reliable data is a huge challenge. We've seen companies just download data into Excel and then try to manually cleanse it, and then you're really left at the mercy of your Excel skills and kind of using somebody who's a bit of a whiz kid with data to try and get everything in order. Poor wallet management aggravates these issues a lot. So again, not uncommon to see a number of startups probably just have one or two wallets where they've centralized all of their activity. Again, there's a related governance point to it where wallets are typically just being controlled by one or two individuals. We won't get into that, but just the data side of things, again, single wallet being used for all transactions. And then again, that leads to issues with, well, how good is the data that you get from that wallet? I mean, how would you even cleanse it in classified transactions. That becomes a huge problem.
And I
Uh,
know, Joel, one thing to that point that we get a lot to with the wallet management side of things. Do you think it's ever too late for somebody to start to, you know, set up new wallets? Let's say the company's already been up for a year or so and they don't have great hygiene. Do you think it's too late for them to get into it? What would you recommend? Anything there?
yeah, short answer is it's never too late. Um, you should actually really look at the overall structure, and basically, as I said, related point is the governance and how those wallets being managed. We recommend always you try and separate wallets by nature of transactions. So you have a single wallet for paying payroll, another wallet for paying service providers, perhaps a different wallet for receiving fees. So the more you can create that separation and segregation, the better it is. And then obviously can't stress enough the governance point, having different people with layers of approvals and so forth. That just bodes for just good governance and just basically good housekeeping.
Awesome. Thanks for that. That's something we see all the time where I think sometimes companies are a little reluctant to start adding in new wallets because they're very used to the current structure and, kind of getting them away from that. So I'm happy you touched on that.
Yeah, and I mean, look, there's no one size fits all. Sometimes it is, contextualizing it to, the facts and circumstances of the company and, what may be some of the constraints. So there may be other ways to work around it. I'm just talking about what's a good best practice to follow. So moving on in terms of converting, I've talked about the data challenges, and you can almost, think about how difficult it would be if you don't have good clean data. Then how do you even convert all of that blockchain data to journal entries, which is what you need for your bookkeeping? So that's a huge challenge. And the more you get data from different sources, how do you get a sort of standard, consistent way of indexing it so that you can then make sense of it? Right, that again is a huge problem. So what we've also seen, and I don't know if this sort of resonates with folks on this call, but a lot of people just default to cash accounting because there's no other way for them to manage. They can only sort of say, oh, we can only take care of what we can see, and so if there's things that they can't see, it's almost like going to cash accounting. New products and business models obviously create complexity. I mean, I'm personally a huge fan of all the innovation that happens in this space. I'm always, really keen to understand new projects and what they're doing. But it's fair to say that every new product or new business model will come with a fair bit of uniqueness and complexity. We have exchanges. We've seen exchanges that are now getting into a lot of structured products and exotic offerings. So margin lending, derivatives, and so forth. So all of those new products and new business models create quite a bit of complexity. I mean, crypto lending is a classic one, and I'll touch on that maybe a little bit later. But that can also create, complexity from an accounting perspective. Interacting with DeFi protocols and liquidity pools creates its own challenges. So fair to say, a lot of innovation, but obviously comes with a lot of complexity. And then the final point is just, I think we all know, lack of standards. There isn't a single set of rules or a Bible that's out there that will tell you how to account for transactions. And what I've seen in the startup space a lot is this tendency to try and almost benchmark yourselves to some publicly listed company or some other financial statements or thought leadership that's out there. And the danger with that is you don't know whether those same facts and circumstances apply to you, because everything in this space is very much driven by your business, your context, your tokens. What is it that you are doing? And this is a nice segue into the next slide. Run over. I think there is a tendency in this space to get lost in the jargon, right? people will talk about all sorts of, oh, I've issued a security token and I've issued a utility token, or my token is different. It's provides you X, Y, Z. Right? Here's what you can do with it. And the danger with that is you start thinking of your token as being similar to like a Binance or some other token that's out there. And you say, oh, well, they've done it this way, then surely, they're a big outfit. I can do it the same way. And again, danger with that is, you don't know what's going behind. What is, the devil's always in the detail. What are the contractual rights and obligations that their tokens have created, and what is the commercial substance of this product or this new token that they're trying to put out there. So I would always think of it in terms of, look through the jargon, always go down to at what does the contract say, what does your white paper say, what does your if you're talking about the sale of a token, for example, which I think applies to a lot of startups, what exactly is it that you are trying to sell, right, as part of that token utility? So we look at that and look at the commercial substance. And yes, this is exactly what I wanted to kind of now lead into is token sale, because traditionally a lot of startups have used token sale as a way of funding their projects. And so this is a great example of where management's view and the gap view completely diverge. From a management perspective, it's not uncommon to see people think of it as a fundraise, and so they will think of token holders as investors. Whereas from a gap perspective, what you have actually done is you sold, if you're issuing a utility token, I mean, that's the big assumption here. But if you are issuing a utility token, what you have actually done is you actually signed a revenue contract, because you are going to provide a future utility to the token holder. So it's actually not a investor-investee relationship. It's actually a customer-vendor relationship under accounting. And so I guess that's just an example of how, divergent, views can be. And obviously, it's important that an investor understands this, because whenever they're looking at numbers, right, again, it's not uncommon. Numbers get presented to them and they don't even understand, well, what does the accounting actually, what is it going to look like when I see a set of accounts, or if this was to go for a listing in the future, what would those financial statements actually look like? What is the revenue run rate that I'm projecting here? So it's important to understand that dichotomy.
And Anuj, would you say here that kind of ties to what you said earlier about the obligations and rights that come with it, compared to, say, like when you issue stock to investors, that comes with a certain amount of rights versus issuing tokens here, like in this example, a utility token might not actually give you any rights to the company itself?
Yeah, excellent point, Tremaine. Because this is, again, a very common kind of misconception that we encounter. People would think of, oh, I've got the token, so I'm sort of part owner of the project. But actually not, in many cases, right? Because the token just gives you a utility, a right to do something on a platform. It doesn't actually make you part owner of the net assets or whatever that project owns. So yeah, spot on. That's exactly kind of what I'm driving at.
Awesome.
So again, just why I want to sort of labor the point on token is because, again, it applies universally pretty much to a number of startups that we work with. And this gets really complex because, again, this is not something you would encounter in a traditional space. The traditional startup doesn't deal with the whole token accounting aspect. And where this gets really complicated is you issued a token, the token gets used. So typically when it gets used, it comes back to you, and then it gets sometimes resold in the market. So you sort of created this whole new economy of your tokens, right? And this may be true for native blockchains, but even some of the layer twos or other projects that have issued tokens, right? We see lots of other new innovative projects that have thought of a new use case for their tokens and want to encourage the adoption of their tokens. So there's all kinds of, sort of different use cases and permutations and combinations of these that you see. And this gets really complex because how do you manage all of that, the token activity? And then how do you reflect all of that in your financial statements? So this is, again, a place where I feel tools like Cryptio are hugely valuable because they help you manage all of these data challenges, all of this, bookkeeping challenges, and just basically get you nice, clean view of things and all of the activity that has gone through the company. So we're moving on to the other side of things. So what I've spoken about so far is more from the issuer's perspective, where you as a startup have created your own token, and you're selling it in the market and getting people to do stuff with it. But now just taking the other side, if you're a holder of a token, so let's say you've invested in a token, how do you think of the accounting rules around that? And before I jump in, one very important point I want to make is you are not, in accounting view, a holder of your own token, right? What do I mean by that? If you've created a token, typically it is not an asset for you. And again, this is something I want to highlight because there's a tendency, again, to have very divergent views around, a lot of founders and a lot of startups will think of their own tokens. Oh, I've created this asset. It's valuable. It's got a market price. I could turn it around tomorrow and sell it for cash on an exchange. Yes, all of that is fair. But again, in accounting rules, that is not an asset that sits on your balance sheet. Again, I'm talking from a GAAP perspective. Your management view of things could be very different. And so again, the more informed you are having those conversations with your investors or any VCs that are evaluating you for a potential investment, just again going into those discussions with that very clear view, so you don't build a wrong expectation in their minds and you don't kind of give them this expectation that, oh, there's going to be millions of dollars of value sitting on the balance sheet day one. And the GAAP view, that just never would happen. So just coming back to a holder's accounting, when you've bought a third-party token, so not your own token, the questions you need to typically ask yourself is, well, what type of asset is it? This goes back to, the fundamentals of the rights and obligations in the contract. Do you actually own the asset? Do you actually hold it yourself in your wallet? Or is it sitting at a third-party wallet? Is it sitting at a custodian? Is it sitting at an exchange? If it is, then what's your entitlement? Maybe you just have a claim on it. You don't actually have the token. And so this then leads to the question of, well, how do you measure it and what disclosures apply? All of that gets, can get sometimes a little bit complex. But the key point here again is look through all of the jargon and really look down to the contractual rights and obligations. So moving on from
yeah, Anuj, I just want to be conscious because we're coming up on 30 minutes. We do have a couple of questions in for you, so just
sure.
Just to keep in mind.
Yeah, thanks very much for that, Tremaine. I mean, we can kind of skip this slide because I've already talked a little bit about this. The holder's accounting really depends on, what drives the inherent value of the token. So just go back to the previous one. Again, maybe two technical points, the slide before this, sorry. Oh, sorry, no, go back.
Oh,
yeah. So
this one?
just to highlight, from an accounting perspective, you can look at, basically these are the typically the 5 categories of assets that you would ever encounter from a GAAP perspective. And the first 2 are almost always ruled out. Can be asked a lot of questions around, can we call our tokens cash or can we call XYZ stablecoin cash? And no. But those last 3 categories, you could end up in those. So again, minor point perhaps that or maybe too technical, but basically you could end up in either of those three categories, and that again goes back to contractual rights and obligations. So moving on, I think really the last couple of things I want to touch on is fair value measurement, because again, this is something that pops up a lot. How do you determine what's the fair value of a token? It's coming from, you have the same token trading at different prices, fixed venues. Again, under GAAP, there are defined rules around how you mark to market tokens and what value you use as your fair value benchmark. And this goes down to which market you consider to be a principal market, and how liquid the token is, and so forth. So I won't labor the point, but I think just fair to say that fair value measurement has its own uniqueness and its own challenges, and do not be kind of just under the misconception that you can just take any price at an exchange or at a venue and call it your fair value. In GAAP rules, that would not typically happen. So moving on, I think just the last bit is there's a lot of different accounting issues that pop up, right? And this is just basically a summary of everything that we've seen working with startups. So everything from network events and how do you account for crypto-based expenses and salaries to crypto lending and tokenization. We talk about miners. How do they account for mining revenue? How do they account for block rewards, staking, and so forth? So there's a lot of different things in this space, and again, these are all very unique to the crypto Web3 space. There isn't a lot of precedents that you can look to in terms of determining what the appropriate accounting should be. So I'll just close by sort of talking about maybe Tremaine the last slide, which talks to sort of I think the concluding remarks. There is now a fair bit of knowledge that's out there. I will stress again, we as a firm, huge supporters of this space, work a lot with startups, so there is a lot of help that we can as a firm provide. And I would really say that the knowledge is growing. There's a lot more thinking that's going into the space. We ourselves have a global working group that meets every quarter to discuss emerging issues. I would say leverage all your advisors and leverage tools like Cryptio, because that's basically how you're going to be able to tackle this beast. And it is quite a beast because a lot of the stuff in this space is very new. It's very challenging for the reasons I sort of shared earlier. And the final point is, yes, streamline accounting and bookkeeping can really help to boost investor confidence and avoid any value erosion, which I think at the stage that most of you would be in as startups is going to be a very, very important consideration. So that's it for me. In a nutshell, Jeff, maybe to talk through his bit. Thank you all for listening.
Anuj, thank you for that. We actually do have a question that's a good one for you. It's what are the best practices for reporting cryptocurrency holdings, transactions on financial statements within APAC accounting standards?
Yeah, so again, APAC, there is no one set of rules because again, various jurisdictions. I would say that most territories within APAC are following IFRS or IFRS-based standards. So there is a level of, I'd say, uniformity that drives. Having said that, I am aware that in certain jurisdictions, there is some limited views or guidance that has been issued on certain things that can also create some divergence. But fair to say, I'd say most of it should be fairly uniform. In terms of best practices, I think it really goes down to just looking at fundamental rights and obligations and just thinking through, well, what would be a best fit basis to do your bookkeeping. I think talking to an advisor is always a good idea to get that sort of second layer of second set of eyes to kind of get across it. And again, this isn't just PwC. I'd say there's a number of other firms and advisors out there that are getting into this space and have more knowledge. So talking to them would be a good idea. I think in terms of best practice, definitely I'd say using an accounting tool like Cryptio would be a really, really good idea, because I think managing this with Excel sheets is just not great. So there isn't a one size fits all answer. It really depends on the nature of the business and the activities. But I'd say at a high level, uh, you know, implementing a tool to get sort of level of consistency in data, uniformity in how you view things would be a great idea.
Awesome. Thank you, Anuj. I think it's fair to say almost everyone on this call has probably spent enough time in Excel at this point, right?
Yeah, no,
Thanks,
exactly.
Yeah, thanks, Tremaine. So just by introduction again, I'm Jeff Rundlet, Head of Accounting Strategy at Cryptio. And for those who aren't too familiar with Cryptio, we've talked a lot about it as a solution. We're a SaaS solution that helps crypto companies or anyone operating with crypto or on the blockchain do their accounting, tax, and financial reporting. So like Anuj mentioned, we consolidate all the different sources, all the exchanges, all the different blockchain activity into one source, and we maintain all the cost accounting, gains and losses, and we help streamline and automate your journal entries so you could have more consistency in your month end and quarterly reporting. So a lot of what I'm going to talk about goes into, what are the problems out there, and, what are we going to do about it? What are the solutions? And that's a lot of what Cryptio is also thinking about, working with companies like PwC, talking with the news, and figuring out what are the biggest industry problems, and how do we provide consistency in a solution. So the main issue is, I think, it's just limited staff and resources. We're a new industry. There's limited knowledge. It's growing fast, as Anuj mentioned, but it's tough to find strong talent. It's tough to maintain that talent, more importantly, because there is limited resources. So it starts with the people. The next issue would be, in my opinion, just maintaining and collecting and maintaining your data, your support. One of the biggest issues I had, and a quick background on myself, I worked at BlockFi for 2 years, so I know what it's like to work at a startup. I know what it's like to drink water out of a fire hose and try to do too much with too little. And one thing you really need to make sure you just take a breath and wait, make sure you do is document everything, all your journal entries, make sure you have support. And that's another thing Cryptio helps you do through automation, through a system. But if not, if you're working through Excel, it's making sure you save down those spreadsheets, making sure that the formulas are consistent, they don't come corrupt, or you don't delete these files by accident, where you have to then recreate your evidence. I think it also starts with different risk assessments. Crypto has unique challenges. It has unique risks associated with it. So it's getting a very knowledgeable knowledge base, similar to services that PwC provides, to identify all these different risks within your company, so you could then provide the appropriate controls to mitigate those risks. And it all starts with complex data. So we're working with the blockchain. There's not readily available data. We're working with CeFi exchanges. We're working with DeFi protocols. A lot of it's unknown. And that's also what Cryptio helps do. We help index blockchains. We help simplify this complex data. If you're working through spreadsheets, or you're working to consolidate the data through Etherscan, for example, it can be very challenging doing all your cost accounting, FIFO, LIFO, for example, and getting it correct. I know when I was at BlockFi, we tried our best to do inventory management, but it just wasn't good enough. We tried to consolidate it on a daily basis, but you really need to do all this work at a very granular transaction level detail. And if you don't, it's just not going to be accurate. Auditors aren't going to say it's appropriate for your accounting. And, it's something to think about getting a solution in place sooner than later, because you're working with data that's going to be ever changing. As soon as you get to different blockchains, it's another complex issue that you have to tackle. So figuring out a good solution like Cryptio to help you automate all these challenges is one thing that needs to be thought about sooner than later. And then, as Anuj mentioned, we're constantly seeing changes in regulations, in guidance, in how to do accounting, and different regulations that we need to follow. For example, FASB is coming out tomorrow with some news, hopefully to give more clarity on fair value guidance and how to do accounting. But there are constant updates and regulations. In the U.S. market, the IRS, the Treasury markets, they're all starting to ask questions, and they're reaching out to the community for answers because they don't have all the answers. They want to talk to everyone in the industry to make sure that they come up with proper solutions. Next slide, please, Tremaine. So one thing to think about, now we talked about getting audit ready. A lot of you might say, but I'm not going through audits, or I don't have to be audited. But the important thing to think about is one day you will, and one day you're going to need to prove your financials. And if it's not to an auditor, it's to your investors, it's to your next funding raise, where you need to show your financials and verify to them what you've made. After FTX, this scrutiny is going to go through the roof, where they're not going to take a sheet of paper at face value. They're going to dig through this, and they're going to make sure that your financials are accurate. So it all starts with proper process walkthroughs and documentations, making sure that you've stepped back and you identify what are the different things that we're doing to get through our month-end close, and how are we going to document this. Now, this is important for two reasons. It's one, to make sure your company knows and understands what they have to do every day, every week, every month. It's to make sure that senior level management understands what you're doing to get through your close, and also to help you identify risks. So in identifying risks and making sure that you understand different aspects of what are the issues going on within your company, you could identify different internal controls. And process walkthroughs and documentation and internal controls kind of go hand in hand. Internal controls are just saying, what are the biggest risks my company faces, and how are we going to mitigate those risks? But if you don't do a control every month, you're at risk of not accurately reporting your financials. So it all kind of goes hand in hand, but it's something to think about sooner than later. I know when I was at BlockFi, we started doing this only when we started getting audited, because we knew that we had to have it for the audit. But if you prepare yourself and you think about these important aspects of what you'll have to do sooner than later, it'll help you get through an audit more easily and stand up to questions.
Jeff, if I could just chime in on that audit point, right? Because I think this is exactly kind of what I was trying to here. You're right that it isn't just about the audit, right? Because just from my personal experience, right? If we were doing a financial due diligence on a traditional business, I usually don't even get involved, because our financial due diligence team and the investors are all across the business, and they can understand the traditional side of things, the accounting and the future numbers, projections. But where it gets really tricky here is because a lot of people don't understand that. And that is exactly the reason why almost every project that we do, when we're asked to do financial due diligence on a startup or a portfolio company by an investor, I'm always involved. They want me involved just so that I can help them understand what these numbers are and what exactly is the story that they're telling. So I'd say in the startup journey, right, or where people are, I think most folks on this call, it isn't even just about being audited. It's actually just being ready to explain your company and explain your story to an investor. And I think that is really, really critical, and is at the heart of this whole problem.
Yeah,
Yeah,
I think
that's right.
Jeff, I think what you said it ties nicely to Anush's point earlier around there's so many divergent views that not having your policies written down can be very confusing to somebody who's walked in and they've seen it go a million ways and they're not quite sure, what it is that you're doing. Let's say specifically if you don't have good documentation of your policies and your processes.
Yeah,
Yeah, and I mean, look,
absolutely.
both things go hand in hand, right? If you don't even have, if you don't even have documents that are audit ready or something that is auditable, then how would a VC or investor ever get comfortable with, going ahead? I mean, that's certainly going to be a question mark in their mind. Right?
Absolutely. And yeah, saying audit ready is really just saying you have sound financials. It's saying when you're asking for support for journal entry or for your quarterly reporting, support, that you could easily hand over all those supporting documentation. You're not figuring out, how to recreate it, or, where these numbers came from. You understand fully where they came from. So it's just really making sure that you really, really think about how you're making your journal entries and what is the supporting documentation behind these journal entries. And I think the other thing, this is more from an audit perspective, but it's working and collaborating really strongly with these audit teams, or with your investors, or with whoever's asking you for this support, because you're going to be working with them a lot. You're going to have to build their trust, and trust takes a long time. So as soon as that there's a bit of doubt in what you're handing over as support for your financials, you're fighting an uphill battle. So what I'll go into in the following slides are a bit of what Cryptio is helping, and a lot of sound financials come down to risk and controls. You have some risks within your company, and you've built in controls to make sure that you're audit ready, to make sure that your financials are sound. With crypto companies, this ends up being a few things which Cryptio helped identify. It's inventory. It's making sure that you have complete inventory. Now, one thing people might not think about is that they have an Ethereum wallet, for example, and they don't know that this Ethereum wallet is actually active on the Polygon blockchain, and they're only pulling in Ethereum balances. So it's to make sure that you have complete inventory from your wallets and the data that you're pulling into those wallets, because one wallet could be active on multiple blockchains. It's also making sure that you're understanding everything that happens within your workspace. So the way Cryptio works is you have different crypto activity, and you have mappings to your general ledger. If there are no mappings, your general ledger or your journal entries aren't going to be made. It's making sure that you have complete reconciliation of everything going on within your workspace, and that the mapping is complete, so your journal entries and your general ledger postings will be complete in turn. The next one, and probably most important, and it's what Cryptio is focused on since day one, is data integrity, completeness and accuracy of data. And the way we do that, and the way we're unique, is that we have in-house data. We run our own nodes and we index our own blockchains. And by doing so, we could also rerun nodes and reconcile the data within Cryptio back to the blockchain. So we prove that we have complete data. But not only that, we have reconciliations for price, cost basis, and any kind of manual activity within Cryptio. So all this stuff, all the activity that maybe you're doing through a manual reconciliation process is now all automated. So you could spend more time on the analytical aspects of your job instead of the manual grunt work. Another aspect of what Cryptio does is we do provide, like Anuj mentioned, the principal markets pricing. So we have the option to pick by asset, by principal markets. What pricing do you want, and what is the best way to price your assets, and to do it consistently. Once you pick a pricing method, it does it consistently through the life of your accounting. Another control which we've identified is related parties. Are you pulling in your complete wallet balance? This is one of the most challenging aspects for companies to manage. Someone creates a wallet and no one communicates that to the rest of the company. They're actively using this wallet, but the accounting team doesn't know to pull this in. So we've identified controls to help identify wallets that could potentially be owned by the company that aren't being populated into your month-end reporting.
And
So the
that's a
next
big
few
one, Jeff.
slides. Yeah, go on, Tremaine.
Oh no, I was just going to say that's a big one that we've seen come up in audits lately. Just that conversation around, are you pulling in, wallets, and how do you give assurance that you're aware of all the wallets that the company uses and things like that. So
Exactly, because that's one of the biggest challenges for external accounting firms to know is, how do I even know that everything I'm looking at is everything? And wallets aren't missing. It's a huge challenge. So trying to mitigate those risks by building in these controls is at least one step forward in giving everyone else a little bit more comfort that you're getting the complete financial reporting and nothing's missing. So the next
And
few
we have
slides are just go on,
Jeff,
Anuj.
real life example of a startup that we worked with that actually had that exact same issue, because what they were doing was they had market making activities going on the side through a related party, and none of that activity was actually being properly captured. So when you look through the arrangement, that wallet in its essence was also a company's wallet, right? And then none of that activity was actually being reflected in the company's financials. So to your point, that is exactly the issue that we saw. And again, it was a mix of, well, looking at the substance, which I maybe kind of stress or overemphasize. But when you step back and take a look at the substance of what's happening there, the question really was, well, where did these tokens even come from? If they came from the company and the company actually does control that wallet, it's no different to any other wallet that the company has, should therefore form part of the company's.
yeah, and that exact test is basically how we even built the related parties module. It was looking at, if you have a large sum of transactions from a source that isn't identified in your workspace, what is that source? Is that actually something that should be included? So it's great to hear from your side, Anuj, that your testing and the way you think about testing is very similar sort of to how we built out that tool. Sorry, go ahead, Jeff.
So the next few slides here, we'll just skim over, leave some time for Q&A at the end. But the risk and controls are something that Cryptio is really focused on. We have separate modules which show when the tests were completed, who it was completed by, who's reviewed this test, and it gives senior level management the comfort that things are being done, and it proves to them that it's being done. And not only that, it provides an audit trail of what's being done. So you can hand over all these reports and all these testings that are being done to your auditors, to your controllers, to your CFOs. Next slide. So this is just another example of WoW completeness. You might be just importing Ethereum, but it's live on 5 other blockchains. So we have all these different controls, all these different modules. Outside of just transactional level accounting, it's the controls. It's the controls that are important to make sure that once you get to your accounting, that it will be complete and it will be accurate. Next slide, please. Again, reconciliation. Do we have all of the assets? Do we have all the mappings that are being done? And again, this is just evidence that controls are being tested and the data is complete.
Yeah.
You can skip forward a couple of slides, Tremaine. Maybe just jump to the workflows, and then we could get in a quick Q&A.
Yeah, got it here. Actually, Jeff, I could even talk to this one a little bit too. In terms of the workflow stuff. I think a lot of this sort of brings together really nicely everything that Jeff and Anuj, pointed out, because the way how we sort of think about building a product, especially for crypto in an industry where there's like Anuj mentioned, so much divergence of, views, and there's no lack of clarity on exactly what are the guidelines, what is the best practice, and things like this. I think what we've tried to do is identify what we've seen work for a lot of people, whether you're a big or a small startup. And again, like we mentioned earlier, I think one of the key things that we've seen come up time and time again is really just around policies and documentation of your policies, right? Making sure that these processes, you're not just like Anuj mentioned, you're not just looking at a big company and saying, oh, I'm like this person, so I have to be, under the same treatment. It's, identifying what are actually the similarities, let's say in terms of the white papers, and documenting that in the policies to make sure that if you have to stand, defend this position to an auditor, it's very clear and there's not a lot of, let's say, lack of preparation on your side. I think the layer on top of that documentation is just having consistent and frequent monthly, weekly, quarterly processes in terms of how often you review your data. How often are you checking to make sure that I have a full list of wallets? Because as we know, new revenue streams pop up, new business ideas pop up, and it's so easy to create a wallet that it's very easy to also miss that the company introduced something new within a revenue stream. So just having some sort of consistent review process for things like, your wallets, your assets, your chart of accounts, how often are you making sure that if I let's say I start to do staking or I start to do bridging, am I setting up new chart of accounts for these different revenue streams? So that way it's very clear when someone looks at the financial statement and can say, okay, yeah, these assets, even though 10 ETH came in this month, not all of it came in from the same source, right? This came in from staking, or this came in from, this revenue stream. I think just getting very consistent with that process, we've seen help a lot. And that's something that we stress on top of, for us to have as the product that helps. But I think if you're not consistently using it and getting familiar with it, sometimes we've seen those gaps still pop up over time. So definitely just wanted to touch on those 2 points. Anuj, Jeff, I don't know if you guys want to add anything here.
Yeah, I can add. I think a big consideration here, again, for those that are looking at this through an audit lens and at least trying to get audit ready, is this is absolutely essential to do even before you go and talk to an audit. And again, look, there are obviously mom and pop audit shops that potentially will sign up to, almost anything. I mean, we've seen, again, I won't repeat the whole FTX saga here, but one of the big criticisms for FTX's auditors has always been, how did you even get comfortable to take on FTX as an audit, given the lack of any sort of documentation and processes and so forth, right? I think the sort of naturally the fallout of that is most audit shops that are out there in the market, and of course, including all the big fours, people, the tier twos as well. The key question everybody is going to ask is this business even auditable, right? And I think going through an exercise like this, or implementing a tool like Cryptio, I think makes you sit back and ask a lot of hard questions, and actually forces you to bring in a level of discipline, which then gets you better prepared for those conversations with an audit. So even if you were to go after like a tier 3 or a tier 2, I think everybody's going to ask the same question and ask about, well, how ready are you to get audited? What sort of documentation do you have? What sort of audit trail do you have? And how organized are you for us to come in and even start evaluating the business? So I think, again, very critical, even if you're just looking to get a statutory audit done. You will not be able to find a decent auditor if you haven't gone through this process.
Thanks, Anuj. And we have a question from Jason, just asking what are some of Cryptio's key advantages over more basic accounting offerings in context of plugin Xero or similar accounting systems. So we do integrate with all the ERP solutions, Xero, NetSuite, QuickBooks, etc. One of the key advantages I would say that we have is more scalability. We could work for a very basic company of the startup at a very low level, but the functionalities that we provide are also a little more advanced. We have our own in-house indexing. And as your business scales, as it grows, you could grow with Cryptio. We have clients with 50 million transactions per year. We have some clients with 100 transactions per year. So you're able to grow and scale with Cryptio and also maintain all your documentation. Through Cryptio, you can do all your different reporting. We have 27 different reports out of the box. You could create your custom reports as you need. So we're the solution that is going to grow with a company. I see, like, I'm not familiar with AEM Journaler, but I would assume it's more of a tool to help you get your accounting done and not to complete your accounting, tax, and financial reporting, and be able to look back over different periods. Within Cryptio, you're expected, you could look back over the past 5 years and run different reports and, do different type of analysis. Tremaine, I don't know if you have anything to add to that, but I mean, those are my main views in how we're a different solution. We're more towards the companies and enterprise level startups where, they want to be a real company, and we'll support them through that.
Yeah, I think those are great points, Jeff. I think the only thing I would add is that a lot of the controls that we've also built in Cryptio is based on what we've seen as best practice from top accounting firms like PwC. A lot of what we do is we collaborate with people like Anuj, getting feedback, and we try to build the workflow in Cryptio to be very similar to those. So the beauty of it is almost going through the journey of the Cryptio process of the monthly reconciliations and things like this will automatically prepare you for things like fundraising and audits just naturally because of how the controls are structured. So that's the only thing I'd add, Jeff, but great points by you.
Great. And I think unfortunately we're out of time, but what we could do is follow up with everyone with some documentation with the slideshow. And if anyone has any questions, we could just follow up with a follow-up call to dig deeper into any of the topics.
Yeah. Just quickly to wrap up, for Cryptio, you can find us at support.cryptio.co to see our support center, very easy to access. We have a guide as well. We're going to be sending this out to all of the participants, so don't worry about trying to get anything on the screen. You'll have all of this ready once we share it. We do have 2 upcoming events that we're going to be at. So the Crypto Finance Forum, both of these are going to be in New York. Crypto Finance Forum, that one's hosted by us. So if you are in New York in the time around September 19th, definitely feel free to drop in, grab tickets, share with a friend. This is a very, very focused event on accounting professionals, CFOs, like partners at audit firms, things like this. So it's definitely where you're going to get a lot more targeted and focused accounting information. And then we're also going to be at Mainnet, which most of you know already is one of the big crypto conferences. To wrap up, I just want to thank Anuj for his time and Jeff as well. Lots of great points that we covered today. Like Jeff mentioned, we'll do our best to maybe send out a little answer to any question that we couldn't get through today. But thank you to everybody that joined.
Yeah, thanks everyone.
Thank you
For having me. Cheers.
Thanks, guys.